a massive round of margin calls might be just around the corner for hedge funds, money managers, institutional investors, market makers, and pension funds. And we're going to explain to you guys exactly why that is here in this video. To talk about margin calls, I think it's only fair to look at the margin debt. And the latest numbers we have for margin debt sits at $664 billion. Now, during the COVID crash, the lowest we hit for margin debt was $479 billion. And now I want you guys to think about what has happened in the markets for a second. The S&P 500 might be above its COVID crash lows, but most stocks are not. Now, I'm sure that does not come as new information. A lot of stocks. One of my largest positions besides AMC is Square. I just believe in the company. I think it's a solid run company. I think it'll be $1 trillion business 5, 10, 20 years from now, right? I invest heavily in that company. It is lower or basically at its COVID crash lows right now. I'm not going to say it's lower than that, but it is very close to those levels within a couple dollars, right? Super low. It's gotten beaten down. A lot of stocks are like that besides some of your, call it safety stocks. Even Bitcoin itself is much higher than where it was during the COVID crash low. So if you actually extrapolate that data, some of the largest weighted stocks like Apple and Microsoft that alone control 15% of the NASDAQ, control over 10% of the S&P 500, are really the stocks that are holding things together, marginally speaking. Yes, we're talking about margin calls in this segment of the video. If those stocks really go, that is where you start to see big problems with margin calls. And crypto was the first domino to fall, in my personal opinion, because crypto at its peak was worth about $2.7 trillion. This was worth about the entire market capitalization of Apple at its peak. And now it's down to $830 billion. That is a fall of 70% since November 7th, 2021. And yes, the total decline of crypto is quite astonishing, right? But it's not anything new. It's not anything that we have not seen before. But the difference of now compared to, let's say, 2017, the last time crypto really went through a major decline, is you have a lot of lending that was going on behind the scenes of crypto. If you had 1,000 Bitcoins or 500 Bitcoins, you could take that to a bank and get pretty much whatever you wanted. You could get a line of credit. You could go out and buy things. You could do a lot with that crypto because it was seen as a lot safer now than it was in 2017. If you had the same amount in crypto in 2017, people might laugh at you because it just wasn't widely accepted 5 years ago compared to what it is today. And the problem with that, like I said, is not the decline of the market cap of crypto. It is the hedge funds. It is the banks that were lending to these crypto institutions that were making hand over fist for the last 2-3 years now. Really, even before COVID, crypto firms were doing okay. After COVID, it all exploded. Those guys are losing billions and billions of dollars. And the way that reporting works, these funds have to report a lot of things, but they don't have to report their COVID losses, their crypto. I'm thinking COVID now. They don't have to report their crypto losses to the world. They got to report a lot of things. They don't report crypto losses. They don't report, credit losses in the way of, lending out these crypto products that are just gone now. The value is literally just gone. And they also don't report their short positions unless they want to. Those are a couple things they literally don't have to report. So the problem goes a lot deeper than the actual numbers that we see. But still, even when we're sitting at $664 billion of margin debt, it's held in those safety kind of stocks, right? Like Apple, I would argue, is literally holding everything together in the markets as far as margin is concerned. That is preventing those massive margin calls. And when you think about it like that, Apple is not really in a good position heading into 2023. They've had a lot of demand over the last couple of years, really pushed forward in a big way. And those are really the earnings that we have been seeing over the past, 2 years now that have been spectacular at Apple. And Apple is even forecasting much less growth for 2023, even negative growth for 2023, and you just seen Apple's factory shut down. If that turns out to be a major blow for Apple, that is where you could literally see margin calls in the markets. And at that point, what are going to be the stocks that get covered on? The stocks that are going to have a more optimistic future in 2023 than what we've seen in 2022. Also, I would argue stocks that have a community behind them that are actively buying the stock like AMC would be the first of which to be covered by the hedge funds. And as of right now, guys, AMC is looking spectacularly bullish. Like, if I were to say or draw up a chart in which the markets look so negative, in which they do right now. Yes, we have seen a bounce in the markets, but a lot of stocks have not played along. It's really your Apples, your big players, your Apple, Microsoft, those guys that have really been carrying the markets up. When you look at AMC compared to a lot of other stocks, it looks much, much better. And there's obviously a lot of positioning by some hedge funds and money managers. I'm not going to lie to you guys. Some of these guys are bullish on AMC, and you can tell by the price action of AMC. And what's actually happening is we are bouncing up above the 50-day moving average. Every time we come down and test that and bounce right back up, that is a strong confirmation signal to you that something is brewing. And my personal opinion is it's the margin calls, guys, because when you think about AMC, do you think 2023 is going to be better or worse than 2022? It's obviously going to be much, much better. Now, this article says AMC, will the last bear kindly leave the theater? AMC's fourth quarter is set to be strong, with the new Black Panther and Avatar set for a strong box office. The company's third quarter earnings outperformed expectations, but suffered from a quiet movie slate. Liquidity remains strong at $900 million, with management expecting positive operating cash flows for the final quarter of the year. And I think that is a big thing to point out, because a strong part or a large part of the bear thesis for AMC has been the company's not going back to profitability. It will not have free cash flows or free operating cash flows to support itself and to really stop burning through its cash. And if that can prove to be the case at the next earnings, well, that is going to be a game changer for AMC. And that puts AMC in a whole new category. And that alone will, I believe, trigger the stock to go up, will trigger algorithmic trading programs to start buying the stock, and that in and of itself will create margin calls in a very big way, guys. I think we're much closer to the end of this story than to the beginning of the story. And when I say much closer, I mean much, much closer to the end of this story than the beginning. AKA, I think the MOAS and margin calls are a lot closer and going to happen a lot sooner than most people think. And this is really a golden opportunity, because most of the time, if you're early to things, if you're someone that is watching this video that is holding AMC right now, in my personal opinion, obviously I'm not a financial advisor, contact one if you need any specific investment advice, because I'm not going to give you any investment advice. Do whatever you guys want. But long story short here, I think a lot of the bad things are out of the way for AMC, and AMC is not a business that really sells anything besides obviously their food and beverages. But why are people going to theaters in the first place? It's to see something. It's to see a movie. That's been AMC's biggest problem. They haven't had movies in theaters, and it looks like for this quarter, for all the other quarters coming in 2023, the slate of movies is going to be a lot better, and that is going to drive the company's earnings through the roof, relatively speaking, compared to 2021 or 2022. And in that case, the bear thesis is literally gone. Now, it says tales of AMC's death have been greatly exaggerated, with the company set to realize one of its largest fourth quarters on record on the back of the cumulative box office of Disney's Black Panther: Wakanda Forever and Avatar: The Way of Water. This will likely push AMC to realize positive cash flow from operations for its fiscal 2022 fourth quarter, as positive developments that will provide relief from a debt burden that has been slowly managed down since the pandemic. And it goes on to say how strong the domestic box office was for Black Panther, and it does go on to say how many screens and theaters AMC has, and how that is going to be such a good thing compared to its peers that are starting to go out of business. It really puts AMC in that ultimate position to capitalize on the demand to go and see movies, and that is obviously the case because we are seeing the numbers coming out, guys. So really, that is what I wanted to go over with you guys here in this video. I just wanted to make my case for not only margin calls in general in the markets, specifically with AMC, and why I think we're much closer to the promised land, we'll just call it that, than what a lot of people realize. And you've been through a lot of bullshit over the past year and a half, and I understand why some people are super negative and have a very pessimistic kind of outlook. But from my perspective here, I think the box office is going to be a lot better going ahead, and I think there's going to be a lot more films. Actually, we know because we have the data here, and we'll go through that in another video. There's going to be a lot more movies, and I think there is greener patches ahead for AMC investors, and especially once you start to get those safety kind of stocks, those Apples and Microsofts that, you know, start to fall in a big way. That's going to greatly reduce the capital that hedge funds have at their disposal to remain and to stay in those short positions, those positions that require initial margin deposits. So guys, that is going to be all for this video. A quick look at the Ortex data currently has us at about 20% short interest, 103.3 million shares that are sold short. Cost of our rates, cost of our average at about 46.25%, cost of our max at 53.22%, and cost of our minimum at 29.52%. So the data here obviously looking very good, and we are still sitting at well over 6 days for the days to cover, and that is also something that is very bullish. We have not been at these levels in a very long time, and that means it's hard for shorts to get out of their short positions if they want to in a fast, you know, pace. If they want to in a small window of time, small window relatively speaking is a couple days in my opinion, that is going to push AMC to levels that I think will make the previous rally look like pennies, guys. So that is it for this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Most importantly, you guys enjoy the rest of your days or your nights whenever you are watching this. I will see you in the next one.